This is the 10-year interest rate on US Treasury bonds. And we can see that more recently, it's been moving quite rapidly. The rate jumped from 4.1% to 4.5% in just a few weeks since early December. While a 0.4% increase might seem small, it's actually a big move for interest rates. And quite often, moves higher in Treasury yields lead to market volatility. If we add the S&P 500 to this chart, we can identify 3 corrections in April of 2024, October of 2023, and February of 2023. In each case, rapidly rising rates sparked these market sell-offs. But these yield-driven corrections actually proved to only be temporary setbacks within the broader bull market trend. Now, if we extend our chart back to 2022, we can see that rising rates can actually inflict much more serious damage to stocks. During this period, the 10-year yield surged from 1.4% to 4.3%, effectively tripling. This wasn't just a quick spike like in 2023. It was a sustained rise in yields over a full year that drove the market into a long downturn. So, could yields continue rising and drag the S&P 500 down over the next couple of months, similar to 2022? If we look at the price of oil against the 10-year yield, while most of the time these two are correlated to each other, right now we are seeing a divergence building between the two. The relationship between oil and the 10-year yield makes sense. Rising oil prices often signal broader inflationary pressures, which in turn drive yields higher. In 2022, for example, oil prices surged above $120 a barrel, fueling inflation concerns and pushing yields higher. But today's environment is very different. While yields have spiked from 3.6% to 4.5%, oil has actually remained more or less flat. This is a big divergence. The fact that oil prices aren't confirming the move in yields suggests that the yield spike likely isn't being driven by economic pressures or inflation concerns. The Federal Reserve, the United States central bank, controls short-term interest rates, and these can also have a great influence on all other interest rates in the economy, including the 10-year yield. If we look at a chart of the 10-year yield going back to the 1970s and add the federal funds rate, the interest rate that the Fed directly controls, we see how these two rates tend to move together over time. Over the past 18 months, the Fed has shifted from aggressively hiking rates to pausing and recently cutting rates. This downward trajectory led investors to believe that many more rate cuts were coming, essentially betting that the Fed would significantly lower the federal funds rate throughout 2025. This expectation of lower rates was pushing the 10-year yield down, but something happened last week. Jerome Powell expressed caution regarding the possibility of future rate cuts. Back in September, the consensus was that the Federal Reserve was going to do 6 25 basis point cuts, which would have taken their rate below 3% by the end of 2025. Following Powell's recent remarks, the market is now only expecting 1 rate cut by the end of 2025. That's a pretty big readjustment in expectations, and this is very likely what has been pushing the 10-year yield higher and the stock market lower.